Good morning. Happy Wednesday. All right. The election is now over and the country still stands. I was out on my jog this morning and I noticed that the streets were filled with people going to work and life continued, which is really good news. Now, that being said, the Fed is meeting today and tomorrow, and they're most likely going to do a 25 basis points cut tomorrow. However, as I keep saying, pay attention to Nick Timros from the Wall Street Journal, who is the current Fed whisperer, meaning the Fed often communicates their future intentions through someone like Nick so the market knows what to expect. Nick had an article this morning in the Wall Street Journal suggesting the Fed may only make one more cut this year, that they're really uncertain about the December cut, but he seemed to be walking back the Fed's appetite for making large or multiple cuts this year. So pay attention. So probably maybe if I'm reading the tea leaves, a 25 basis point cut tomorrow, then we'll see how the data goes in the next 30 days and maybe stand pat. As you know, the market's reacting today to the election. It really doesn't matter who was elected. There's going to be inflation pressure with either candidate. Both want to spend money and not necessarily, have taxes cover that money. That's inflationary. So, market was going to react probably either way. Now, today I want to talk about ICE's November 2024 mortgage monitor. And this report comes out every month and it's always filled with great data. I'm going to get to the data that's most important because what they do is they have the same kind of data they follow every month. And then they have like a kind of like a specialty section on a topic of the month. And I'm going to address that. But if you haven't seen the ICE report, check it out. I'm just going to flip through the report really quickly, and then I'm going to get to the data that actually interests me. But it lists delinquency rates, which are non-existent, foreclosure starts, prepayment activity. It goes in and gives you data every month on not only mortgage performance almost by city. It has a really good report here on properties affected by the three hurricanes. Exactly how much mortgage balance is at risk, how many late payments are coming because of the hurricane. That section was pretty interesting, actually. I could have done a post on that and talked about it. And it's really interesting. Share payments not received by the 15th in the storm affected areas. It then gets into different interest rates, the Treasury, 10-year Treasury, 30-year fixed spread. Really good data there. It tracks prepayment activity by type. Type is paid off, refinanced, that type of thing. It gives you prepayment speeds by vintage, origination year. Super interesting. All really interesting stuff, guys. National payment to income debt ratio, which currently stands at 34.3, gives you a historic look through 1978. 34.3 is slightly elevated. It's certainly not the highest in the cycle. Mortgage applications to purchase home, just great data. All these have nice charts in them, so check it out. I put a link in my notes below. I also did a LinkedIn post today with highlighting the information that I thought that was most relevant, at least to me, and a link to and to the report. The link is actually to a press release, an overview of the report, and then you can click through to get the PDF report. It's free, so just feel free to do that. Now, here's the stuff. It also has, by the way, appreciation rates across the country by city. Has a cool little, like a heat map with arrows up means price appreciating, arrows sideways means it's flat, arrows down means it's depreciating. Pretty interesting chart, really good. Equity utilization. This is the section we're going to talk about, is the equity utilization. All right, and this has all sorts of good stuff. And I'm going to boil this down to really a few simple things that I thought were most relevant in this. Gosh, I don't know, in this 22-page report. So let's start. I'm talking about affordability, inventory, equity, and HELOCs. Okay. So affordability, the average mortgage payment required to purchase a home rose to $2,317 per month in October, up 5% from the previous month. This payment now represents 34.3% at median household income, nearly 10% above the historical average of the last 30 years. So for the last 30 years, DTI has been 24%, and last month it was 34%. Now 34% is manageable, but not optimal. So just understand, that's why there's tension. That's affordability. People can afford it, but it's uncomfortable. And so we have to kind of help them manage how to make it more comfortable. Now, active inventory saw growth for the eighth straight month in a row in September. 8 months of growth, that's great. Up 3.5% from the previous month and up 34% year over year. Now, despite that, inventory is down 12% from pre-pandemic levels, and of course, we have a bigger population, so it's exacerbated. Now, active inventory are inventories not in escrow. Inventories are listed, and ICE says there's 400,000 homes listed nationally in September. And so there you go. Interesting, right? Now, equity, this is confusing because I reported on equity last week and I used different numbers, and I'll tell you why there's a difference. So, and here's the key, right? The first few words, U.S. mortgage holders. So, U.S. mortgage holders collectively hold about $17.2 trillion in home equity. Last week I reported, though, that there was over 36 trillion. What's the difference, do you think? Well, the difference is 40% of homes in the United States are owned free and clear. If you put the equity from free and clear homes into that number, that's how you get to the 36 trillion. All right, so of the 17.2 trillion, 11.2 is classified as tappable. So 11.2 tappable means you have at least 20% equity after the refinance. So that's what tappable is. So 11 trillion, and I think that number is, if I remember right from my post last week, it's significantly higher, like 17 trillion when you take into account the people on their houses free and clear. The average homeowner has $319,000 in equity, which $207,000 is tappable. Remember last week I quoted the number 400,000, but that includes people that don't have mortgages, so that's the difference. Interesting. So then what are people doing with this equity? Well, total equity withdrawals hit $48 billion in Q3 in last quarter. We did $48 billion in equity withdrawals. That's the highest since the Fed tightening cycle, so it's the highest in about 2.5 years. It was $27 billion from second lien products and $21 billion from cash out refinances, both at 2 years high. However, and this is interesting, this is really interesting. This next part is interesting. So $48 billion in cash out or seconds last quarter. It's a 2-year high. However, that equity withdrawal rate is less than half of the 10-year average. And, if you go back 10 years, interest rates were in the 5s and 6s. We've been approaching 5s and 6s, and yet people are taking half as much equity out when they have double and triple the equity. So there's an imbalance there. I don't know if that means there's a pent-up demand. Certainly so. If it's, an affordability issue, very interesting. But I'm telling you, you don't need to tell you. You can figure out there's going to be a massive equity, withdrawal at some point. We're going to get to a tipping point. And that speaks to, let's talk about HELOCs. We're going to talk about the rates. So the average rate on a HELOC right now is around 9.5%. However, as the Fed is signaling, lowering interest rates, that could drift as low as 7% by the end of next year, which would actually lower the cost of a monthly payment, interest-only monthly payment on a $500,000 line of credit would lower the payment by $300 and make it much more affordable. So as interest rates come down, of course, there'll be more HELOCs. Interest rates come down, there'll be more cash out refinances, more seconds. There's a pent-up demand. We're less than half of the 10-year average of equity withdrawals. So there you go. Read this report. I just touched on a handful of points out of hundreds of points. So check it out. I thought the most important points were home affordability, inventory trends, record equity levels, equity withdrawals, and HELOCs. So there you go. That's my message. Happy to see the world still spinning today. No major problems from the election. Happy to have the election over. Happy to focus on just head down, helping people get into homes. I hope you're having a great week here on this Wednesday. And I look forward to talking again tomorrow. Thanks so much. Bye.